Initially acclaimed as a solution to reduce accidents, self-driving cars were expected to be widespread by now. However, their scarcity is due to engineers underestimating the technological challenges of their development. Financial Mail's David Furlonger joins us now to discuss this prolonged development. Thank you so much for your time,
Pleasure.
David. I did not know about this. So I went last night and I looked up self-driving, and it turns out that there are different levels of automation. Because in my mind, I thought it's either you're in the car or you're out of it. So when we talk about self-driving now, what do we actually mean? Who makes the decisions, and does the driver need to be inside the car?
There are various levels of autonomy. Almost all of us drive a car with some level of autonomy. As soon as you get ABS brakes, which override the driver in an emergency, then you've got a certain level of autonomy. If you've got cruise control, if you've got lane changes, all sorts of things, those are all various forms of autonomy. It's only when you get to the top layer, which according to whichever set of tables you go, but in many of them it's the fifth level, that is when it's a completely self-driving car. When you get in, you program where you want to go, then you sit back, read your newspaper, and it takes you there. And we are a long way from that at the moment.
I must ask you, David, about the pursuit of this, fully autonomous vehicle and self-driving here. Why?
They started talking about it seriously in the 1980s. The main reason was safety. If you look in the US, 94% of motor accidents are caused by driver error. It's lower here because we have drunken pedestrians, we have bad road conditions, we have animals roaming the streets, but it's still a very high percentage. And if you talk to the statisticians and engineers, they reckon they can cut accidents by 90% if you have a self-driving vehicle. Because if it has a purely logical mind, which we humans don't, because we get distracted, all kinds of things go on. So if it's purely down to science, they reckon they can cut the accident rate by 90%. It's not really feasible, because what they're finding is that the technology really has lagged so far behind. And also, if you're a car, if you're the brain of the car, there are just so many distractions, so many things going on, hundreds of things which they have to take into account at any given moment, that even they are failing at the moment to reach the levels that scientists thought they could.
You talk about driver error, but there have been reports coming out, for example, with Tesla that, drivers also still need to be aware so that they can also take over if something happens. So does it speak to how far behind the technology is, but also what is the gap technologically and in terms of the timeline for us to get to what is desired?
Yes, when it comes to Tesla, I mean, they've had, in the US, they've had 20 accidents since December.
Yeah.
Part of that is down to the fact that the company is pushing the limits. It's pushing on a little bit too quickly. So they are making technology changes over the air. So they're not installing it physically. It's all done from the cloud, if I can put it that way. So that's one of the challenges they're having. Also, in terms of that full self-driving, which you're referring to, what they're allowing in the US at the moment, and it's coming in China, and let me just say, in China, they have just licensed the first company to mass produce completely autonomous flying taxis. So if you look at what's happening overseas, we have a long way to go there. But in the US, what they're allowing now is the licensing of vehicles which are fully autonomous on highways. So you get on the highway, you program where you're going, but you still have to keep an eye on the steering wheel as you go, because there is still that risk that something can go wrong. And if it does, you need the human backup, that fallible human backup.
I must ask you, David, here about then the issue of feasibility and then from feasibility to cost. Because, of course, like you're saying that we're still trying to figure out if this is even feasible, but investment is moving in this direction. We heard of Elon Musk's great trip to China where, we had some of that legislation or moved for him. But I'm then keen to find out about whether this is something worth investing. I mean, as Zinati did mention Tesla, and Tesla's whole thesis at this point is on the software for fully autonomous vehicles.
Yeah, I mean, it absolutely is feasible, completely feasible. The problem, well, there's a couple of problems. One is, originally they thought by 2020 there would be hundreds of thousands, possibly millions, of very, very high autonomy vehicles on the roads. One reason is that, or one reason for the delay, is that all the motor companies have been sidetracked by the needs to look at electric vehicles and all these other technologies, because their deadlines have just come progressively forward. But it's also the realization that the technology just doesn't work as they expected to. Only 26% of consumers in the US are prepared to drive a fully autonomous vehicle. People simply don't trust it. But if you look at the timelines now, they say that fully autonomous vehicles will be widespread by 2030, but not here. I promise you, not here. The reason being that you need functioning cities and you need functioning drivers. Now, if you look at some of the Chinese cities and some of the US cities, they are setting out autonomy-friendly grids where people can travel on properly maintained roads with proper technology running their systems. Here, and let me give you an example. You stop at a four-way stop in Johannesburg where no one obeys the rules, where the taxi drivers go everywhere, where pedestrians are all over the place, where you're surrounded by potholes, and where no one really takes the four-way stop or the traffic lights terribly seriously. So you could be sat in your fully autonomous vehicle, you could be sat at your intersection for the rest of your life while it awaits a safe moment to go. Because in a perfect world where every vehicle is autonomous, it'll work because they will all respect what's going on. But at the moment where everyone is doing their own thing, no thank you.
I was reading an article about how some of these cars can't detect the speed of a bicycle that is driving and goes behind a car because it's not disappeared. I don't know how they will ever see the taxis coming.
Well, I was going to say, it's not just the taxis.
Yeah.
A lot of the accidents have been at night because they're not detecting things at night. And possibly one thing which would be for the good of humanity, even though we are journalists, when Volvo did a test of an autonomous vehicle in South America a little while ago, they showed it off to all the journalists and they'd put in everything which they needed to recognize the curbs, the other vehicles, high-rise buildings. They hadn't programmed in journalists, or rather human beings. So the vehicle went off and it knocked down 5 journalists. Now, some people might think that's a good thing.
How poor colleagues. Thank you, David. Very fascinating stuff indeed. That was editor-at-large for the Financial Mail, David Furlonger. And in case you missed it, China has been struggling to regain ground post the COVID-19 pandemic. The East Asian nation's stock market has shed 40% of its value over the past 3 years. Despite the downturn, some investors aren't writing the region off, saying there's still value in that market. On the close, United caught up with Simon Fillmore, Chief Investment Officer at Independent Securities, to explore some of the pockets of opportunity in China. Considering the shift to Chinese equities, she kicked off the conversation asking him if the big thing here is really the valuations which are too cheap to pass up. Here's that conversation.
Certainly one of the aspects one needs to look at is the valuations. And if we just look at a pure index level, the Hang Seng index is at the same level, at the same place it was 27 years ago. So on that basis alone, it looks like it's offering great value. And then when we drill down further into the underlying companies, we find some of the cheapest investment opportunities we've certainly seen over the span of our investment careers, which is typically what you would expect at the bottom of a market. And so just to talk about some of those opportunities that we see, and some of the valuations that we see.
Yeah.
If we look at a business like JD.com, which is one of the third largest online retailers in China, it has its net cash balances represent 80% of its market cap, which you just don't generally see. It's literally unheard of. Similarly, with a company like Alibaba, a third of their market cap is represented by net cash, which is also, once again, very cheap. And then if we look at just the pure old PE ratio, which is a shorthand, but it does give some indication of the valuation, both of those companies are trading at very low single-digit PE multiples.
Does that translate to significant earnings momentum? Because, for example, when you look at the US, it's still quite clear that earnings are growing in line with economic growth that is still strong in the US. There has been concern over the macroeconomic environment in China, and particularly the momentum, or rather the pace of growth that we have seen with economic growth, though. Can we, expect, any boost in earnings while, I guess, the economy still maybe has this kind of choppy narrative around it?
Yeah, so I think you're quite right. The growth in China, certainly amongst corporate growth, specifically in the IT sector, has certainly slowed. And that's one of the reasons why these shares trade at the valuations that they do. They obviously had a massive regulatory crackdown a couple of years ago, and that impeded their ability to grow. And that's one of the reasons why we've seen the devaluation of these shares. But I think that's one of the reasons that we're getting excited about them now, is that there's an opportunity for that economy to change and move from manufacturing, industrial, infrastructure-led into consumption-led growth. And we feel that it's that consumption-led growth which would be a trigger and a catalyst for broader economic growth. And basically, what we have seen is investors have been expecting big bang stimulus from the CCP, much like we got in 2010 and 2016. But so far, they've been disappointed. And we don't think there'll actually be a similar type of stimulus. But what we are seeing are more subtle signs. And increasingly, the CCP is trying to encourage investors to invest in the stock market. And the reason why they're trying to do that is just because when the stock market goes up, people feel confident, they start spending money, which raises employment, is good for productivity, leads to high GDP growth. So that's what ultimately they're trying to achieve. And the measures that we've seen the CCP implement are they've halved transfer duty on purchases. They've encouraged institutional investors to participate more in the market. In terms of insurance companies, their capital adequacy requirements have been changed more in favor of equities. So it's a balance of those where we see the government just increasingly ask institutions to invest more in the market. And we think as that goes, as the market turns and starts increasing and people's wealth increases, that'll just set off a positive feedback loop and set off this virtuous cycle.
That was Simon Fillmore from Independent Securities.